Hello and welcome to BQ Prime. I'm in conversation with Sahil Kapoor from DSP Mutual Fund. Hi Sahil, thank you so much for taking time out for us today.
Thank you.
I'm going to begin with something that's top of everybody's mind today, oil prices. We've already touched 90. I do want to understand what's the impact for the economy going forward, FX, CAD, growth, and of course, inflation.
Sure. So what we've seen historically is that if oil remains above 90 for at least a 3 month period, it begins to make a difference to our international situation, external situation. Our imports rise quite a lot in dollar terms, and it begins to hurt. And historically, when we've seen oil between, let's say, 95 and $100 for, let's say, a 6 months period, usually we've seen at least 50 to 100 basis points increase in our 6 months CPI, which is quite sizable. So that is something that we should be, cognizant of how oil prices move. Second is of course, our external situation, right? Our trade deficit that goes up as well. And I think these two are the bigger vulnerabilities that we have. But over time, they have become smaller because GDP size has grown. But you could say that 90 to $95 crude oil price is sort of a Lakshman Rekha, beyond which I think these troubles begins to brew, and where it is right now. But my own personal sense is that oil prices may not remain this high. The underlying demand is weakening, although there are a number of supply cuts which are in place right now, which are taking care of that excess weakness in demand. But one thing is very clear: last 4 5 days ago, Saudi Aramco highlighted that they want to do a $50 billion offering of their stock, and we've seen that historically the company has tried to play around with the oil price when they want to offload their equity. This, I think, would also be at that phase where they want to keep supplies tight so that they get a good price for their offering.
All right. While we're talking about this downside risk, we cannot ignore the risks from the southwest monsoons, just considering the volatility we've seen and deficient rainfalls in August. September, of course, remains unclear at this juncture. So, what's it looking like?
So historically, what we've seen is the data, as far as I know, is if by mid of August you have about 600 of rainfall, usually you don't see a big hit to our, crop production levels. And we had that number this time, and our numbers were fine in terms of sowing. They have deteriorated, somewhat in last 2 weeks, and reservoir levels have also come down slightly below long-term average. But I don't think right now they are alarming. If we get a revival, which is what IMD is saying in September, then probably we'll scrape through this period and there will not be a very large impact. But if you see a deficit of, let's say, 10-15% in overall rainfall, then possibly agri GDP can get hit. We are close to 4.5% growth for agri GDP right now. Historically, it slips below 2% when this kind of a hit occurs. So there is definitely a reason to look at this data. But present data is not too bad. I think we are in okay environment. If this pans out, let's say a 6-7% deficit also, or 8%, I think we'll be okay.
Right. And at this juncture, the narrative is that inflation to the bump up that we have seen is largely transient. Should the southwest monsoons recede while being deficient, what's the outlook there?
So largely, I think it will remain transient in terms of the overall impact, because one clear risk from a lower monsoon is horticulture production. I think those numbers are still okay. We had a very large bump up over the last 10-15 years. So I don't think we are going to slip significantly. But yes, these month on month variations in price, they can continue. Second thing is that India is a very price sensitive market in terms of inflation also. So what we've seen is that if you have a 2-3 month period where, let's say, vegetable prices go up through the roof, what tomato did 2 months ago, in those periods, your disposable income in the weaker sections of the economy, they get hit quite a lot. So it comes and hits your demand significantly, but only for that period of time. So I think it is an important risk that we run for the rest of the year. But as I said, the numbers are not so bad right now in terms of reservoir levels or the overall crop production levels. So I think we should be, you know, able to see through this risk. Second thing is our core inflation is still falling. So it's below 5% now, or about 5% now. So which is a source of comfort. Second and thirdly, probably our top line numbers are falling. Our nominal growth is slowing. Even tax growth is now slowing, right? So it tells you that the GDP deflator or the inflation, core inflation is not very strong. The trend is not very high. So these transient factor will not be able to increase it further. So you have an falling mean and you have maybe these transient factors play in between.
So, the first risk that you touched upon, now at the current juncture, we're at a crucial time because, we're talking about a season like the festive season. And so far, it seems to have started off on a good note. But how much of a dent do you think inflation can make in the current scenario?
So from a longer term perspective, if you look at, let's say, past 10, 15 festive seasons, I think we are in a very comfortable environment as far as inflation is concerned. It's not a very inflationary kind of an environment. Core numbers are fine. So I don't think it will make a significant difference. It's rather, I think it's quite positive in that sense that inflation is not so high in comparison to a few seasons that we've seen in the last few years. So I would take it more as a enabler in terms of the overall demand environment rather than being a risk.
All right. Another aspect, like another space where there's been quite some activity in recent days, has been the rupee. And there are expectations that we could see a little bit of weakening even from here on. So, what are your expectations?
Largely, I think it is a function of rupee not doing anything. In the last 12 months, rupee has been in a very, very narrow range, right? Maybe about 2.5 rupees odd. And I think largely the expectation is stemming from the strength that we've seen in the dollar index and which is hitting back on the rupee. But when you look at the factors, one, that inflation differentials for India is still very stable and not slipping on that. Foreign flows are very stable. FI flows were patchy last year. I think this year they've been stable. FDI flows, which had gone down, I think they are now, more or less stabilizing. Our trade deficit, which had gone to 25, $27 billion a month, is now below 20 and, hovering between 80 and 20. So I don't see there are many red flags for the rupee. There could be short-term, volatility based on flows, sentiments, etc. But I think largely the range will hold. Maybe we'll slip up by a rupee or so, go back to, let's say, 83, half 84, which are new lows. But I don't think a large move could unfold given these numbers. If they remain stable, I think rupee will continue to be in a broad range.
Got it. So, to conclude, what are high frequency indicators broadly looking like at this point?
So most high frequency indicators that are important right now, most of them are maybe plateauing. For example, every month you are seeing GST growth slipping by about 50 basis points or so from 13.5 to 13, 12.5. Now it's come to 11, 11.5. So sort of a disinflationary environment is setting in most of these numbers. Even one more data point, I'll tell you that out of BSE 500 companies, now I think 1/3 of the universe is seeing a decline in top line sales growth. So there is a disinflationary trend overall, but when you look at sentiment indicators like a PMI, they continue to rule at lifetime highs. So business sentiment is strong, but I think the big base buildup or the very high YOY numbers that we saw last year, they are now coming back to more normal levels gradually because your WPI is negative, your commodity prices have come off. So on the whole, I think there is a mixed picture. The picture is one, sentiment remains strong. B, the numbers are slowing down to more normal levels, which is where they should be.
Actually, I do want to ask you for your view on long dated securities. At this point, does it still look like a good space to invest in?
So we think that all the negatives are priced in. Globally, most markets are looking for, let's say, the last hike, or they are looking for a cut in next 6 months or 7 months, etc. In case of Indian yields, I don't think any expectation is built right now. Secondly, we had these intermittent shocks of inflation and other, which has probably widened the 10-year minus repo spread. It's at about 75 basis points now. And if you go back in history, when the cycle is already off its peak, which means that central bank has stopped raising rates, this is a good spread to have, 75 basis points. So we believe that playing duration or buying longer dated securities is a good trade today. and it could maybe slip back below 7% in terms of the 10-year, as and when this disinflationary cycle plays out. So both of them, I think, will go together.
Got it. Thank you so much for taking time out for us today.
Thanks.
Stay tuned to BQ Prime.